So next up, Mischa Fischer. Now, Mischa is the chief economist for Angi Incorporated, where he leads market research, including customer spending behavior, labor market dynamics, and residential housing trends. And Mischa's research and insights have appeared in a wide range of popular and industry press, including the Wall Street Journal, New York Times, Washington Post, Fox, NBC Nightly News, Forbes, Business Insider, and a bunch of others. Now, Mischa is also an instructor in applied quantitative, I think I said that right, Mischa, I'm not sure, methods and statistics at Northwestern University. And he's also a member of the American Economic Association and National Association for Business Economics. So with that, welcome to the webinar, Mischa, and tell us what's going on with the economy.
Thanks, Tim. That was wonderful. So he closed out his presentation talking about make sure that you are earning your money for you, that you don't lose it. And that's a really, really important point and a great segue, because there's more than one way to lose your profits and to lose the benefits of all your hard work. And so what we're going to do is we're going to first run through what's going on with inflation, because that's kind of top of people's minds right now, both inflation and gas prices and what are materials and supply chains doing. And the reason why this is important is that economists nicknamed inflation the cruelest tax. And the reason we say that is because it comes along and takes all the benefits of your hard work without you even realizing that it's been taken. And that can be pretty dangerous to your business. So you have to make sure you're protecting your profit margins. So we're going to run through a couple of really top line important numbers for you to keep in mind that I think will help you protect your profits first and foremost. So Tim, if you want to pop over to the first slide here, and what's going to happen is as we cycle through these slides, we're just going to add a line to this, because I didn't want to give you all of the upfront trends, but as we stack what different things are doing together, you can really get a picture. So what you're looking at here in the red line is the broad-based consumer price index, and that's what people are talking about with inflation. And if you look at the very right-hand side of the graph, you can see certainly inflation is up. That's gotten steeper, and that's important to think about. If you are used to charging X, consumers are now facing a higher price for other goods and services in the market. And maybe you're thinking, okay, well, if the broad-based price inflation is 9%, then that's what the prices I should be raising are. But if Tim, if you want to slide forward just once, just click forward on the slides, we can add a few pieces to this chart. And you can see here, we can see construction services and construction goods. Construction goods are what we tend to think of in terms of the various input pieces to an overall construction project. It can be various pieces of materials, it can be fixtures, fasteners, any of these top line pieces. And then construction services are what, say, if you're a general remodeler or a home builder and you're paying another company to come in and haul away your refuse from your job site, that would be a construction service. And you can see that inflation there is considerably higher, multiples, 3 times roughly on average what it is in the general economy. So first off, what does this mean? It means if you're using 8 or 9% as your heuristic for how you're thinking about inflation, you are running the risk of really losing your profitability insidiously and quietly. And you want to really make sure that you're paying attention to not only what you're charging your customers, but also what you're paying for all of these things, and keep track of individual pieces. So if you have an accounting team or some other part of your business process that keeps track of these things for you, make sure you're looking at what you were paying a year ago or 2 years ago for these things, and make sure that your profit is growing at least staying stable, and make sure that your revenue is going up to make up for these higher cost of inputs. But this isn't the whole story. So Tim, if you want to click forward again, we're going to add another line here. And you can see this is home prices. So home prices are up even further. And this is where some risk comes in for if you have a lot of employees, you have to be thinking about, are they able to buy into their communities and what do wage rates have to do? But also recognize that there's an opportunity in here as well. And the opportunity comes from the fact that if you are a consumer out there looking to buy a house, now is suddenly not a very good time. We had a really, really unique opportunity over the last couple of years where, because interest rates dropped by roughly 1/3, it was really a good deal to suddenly buy a home, because the long-term 30-year cost of the money to own the home had dropped so much, so people could bid up the starting price by a commensurate amount. But now that those prices have been bid up, and interest rates are starting to rise, the overall price of homes has gone up, and all of a sudden a remodel or some other form of construction of an existing structure is a better deal for consumers. And what that better deal means, though, is that your pricing can also reflect that if you're not in the new home construction business. If you primarily deal with residential existing homes, the value that you provide to consumers is proportionally more competitive. And this really leads into sort of a final point, which is about wages. And so, Tim, if you want to click forward, we'll add one final line to this chart. And you can see this is the overall wage rate that people in residential construction are earning. And it's not up very much. It's higher than CPI. So it's, if you look at the red line on the right versus the blue line, you can see we're doing a little bit better than the general population. But if you think about what's going on with the overall environment, people in every single sector aren't earning enough to proportionally make homes cheaper anymore now that the prices have risen. And on top of that, if we're looking to recruit and pull more people into the industry, then there's a really important lesson here for how much your wages have to go up and how much they have to rise to attract and retain people. There's typically a premium pulling people into the construction trades, but that premium is not as high as it used to be, and it might need to be a lot higher. So really start mulling over your wage rates, because everything else is up, wages aren't up as much, and I think that that's another area of risk. And the big takeaway from all of these things is don't be using 8 or 9% as your rule of thumb when you're thinking about how much you might need to raise prices. Really examine all of the different costs of your inputs, because you might find that they're higher than that year over year. So moving on to the next slide, we can see that overall inputs, there's a dramatic story in terms of what the rising prices are doing for different things. So if we're looking at what producers are facing in terms of higher costs for the products they're making, you can see that starting with the pandemic, it shot up for manufacturers of ceramics, plumbing fixtures, and a bunch of other inputs that we use in both remodeling and new home construction. And so you can see that their inflation is considerably higher than that 10% average. You can see that that's much higher. It's multiples of it. Going forward to the next slide, we'll also see it's the same thing with roofing materials, but it's not a common story. So if you look at asphalt shingle roofing, the prices that producers are paying are up roughly 10% from the start of the pandemic. But if you look, the prices that they're facing for manufacturing steel is almost double. And so even within these different categories, you can see that there's different areas. And this is the prices that producers are facing to make their materials. So if you're commonly buying these materials from producers and you haven't noticed prices rise this much so far, recognize that they might eat some of that cost in the short term, but in the long term, they'll pass those costs on to you, and you need to make sure that you are passing that wisdom and knowledge on to your clients and setting expectations for potential price increases. And then also following up on a really important point DS made was, are you building in really safe clauses to your contracts to control for these things? Because I don't think we've seen the end of increasing materials prices, because the supply chains remain disrupted, the demand remains high, and producers have not necessarily passed on all the costs that they faced this past year, and they're going to preserve their profits too. So make sure that you are really monitoring that closely. Moving on to the next slide, you can also see this is true with lumber, and the overall price of softwood lumber has gone up considerably. I don't think we're going to see a return to $2 2x4s anytime soon, if ever. That was a very nice benefit of the quiet period of home construction in sort of the mid 2010s. But now that home construction is back up, now that there's so much demand for remodeling, we're facing probably higher prices for the foreseeable future, because the capacity to build out the supply for lumber mills and for transporting these materials is not instantaneous. So if you're looking at 30 or 40% increases in the demand for new home construction, you can't expect necessarily people to increase that much supply within the milling process that quickly. And so this is another area where you want to really be intentional about prices, but then also be intentional about where you're sourcing from as well, because you might have some lumber yards that might not stock anything if the prices rise too much. They might say, I'm too exposed, I don't want to be caught holding the bag if prices drop. But you might have other ones that might hold on to that old inventory and sell it to you at a higher rate. So obviously in periods of high volatility, you want to make sure that you are shopping around and really aware of all of your different options that you have when you're sourcing these materials. And moving on to the next slide, we can also see that this is true with hardwood lumber as well. So it's softwood and hardwood. Obviously, they have very different purposes in terms of home construction, but you can see it's very similar rates of increase. Hardwood's not up as much as softwood, but it's still pretty high. And again, these are producer price indices. So if you've noticed that your producer has not raised the final cost to you as much, recognize that they might just be doing their pricing on a longer term cadence, that they lost some profitability potentially depending on the product line or the cost of the inputs, and that they'll raise those prices proportionally going forward. On to the next slide, Tim. If we can jump into what's going on with labor supply, moving forward, we can see that the overall shortage worsened by about 10%. This is our Angi metric of how we keep track of labor supply within the marketplace. Year over year, 10% is a pretty big increase in terms of how much the shortage worsened, because we were starting with a really high baseline already. So we'll see what 2022 brings. I expect it will be a similar story where hiring is just very difficult. And there's some really interesting long-term macro fundamentals driving why. So on this next slide, what you can see is the overall construction quits and openings environment. And there's a lot going on here. So Tim, if you just want to click forward twice, what we can do is see that there are a couple, actually let's just do one more click forward, is what these are doing is we're adding the overall view of what the average is like over these different periods of time. So if you look at that first line on the left, the periods of the 2000s was a boom year for home construction. We were building a lot of houses. There was a lot of quits and openings, but that was pretty stable, right? Even though we were booming, people weren't that concerned with the labor supply and how hard it was to retain people. Then if you look at the middle line, you can see that there was that period following the Great Recession where the churn in the labor market was much more stable and even lower than it was in the 2010s, because new home construction had ground to a halt. There wasn't necessarily as much demand for remodeling, and the overall environment was pretty stable. But you can see over on the right-hand side, we are now at something that has never happened before. We're in unprecedented territory in terms of construction openings and in terms of construction quits, and the gap between the two. So right there, you can see how elevated the overall average is over this period of both the pandemic and then even leading up to before the pandemic, as the economy was already strong, in the 2017, 2018 period. And as a result, that's going to put a lot of upward pressure on prices for labor, because there's a lot of demand for it. And this is one of those areas where I'm not quite sure our industry has really quite figured out how important it is to pay competitively over the long term. We tend to have sticky prices and sticky wages in a way that companies that are very, very large employers don't have. Right? If you look at the technology sector or manufacturing, they tend to be larger employers on average than in home services and home improvement, and in all of these other sort of tertiary home industry sectors. And what that means is that we're not always as quick on the ball with raising rates in the same way that we have to, because a larger business is going to be paying closer attention to the actual metrics surrounding wage rates. We still pay a premium. That's good. It's important. We should highlight it. We also have really, really high job satisfaction. Also important, also something we should highlight. But if you look at the premium that you get going into the construction trades, for example, somebody from the services sector can double their hourly wage. That's a great deal, right? They might even be working more too. So they might triple their overall money if they're working more and doubling their hourly wage. But that premium is actually not as big as it used to be, and it might need to be higher than it used to be, because some other sectors are now offering people the capacity to work remote and work from anywhere, and they might value that at a few dollars an hour on average. And as a result, it's clear that our wages need to go up in order to attract more people, and that's also something you should be thinking about when you're doing your pricing. If you can't retain the labor to get through a job quickly enough, you might need to be thinking about your pricing and your wage rates in a way that holds people in and reflects that in your overall bids that you're putting to consumers, and also really level set their expectations that this is the environment. We're going to talk about a little bit how rich consumers are. That's great, and they can absorb these prices in a lot of cases, and that's important because our industry also has this other unique quirk where we really get overbooked and people just stop taking new clients in some cases, and that's not the way to run something, because if you look at most other markets, they clear pretty instantaneously. If somebody wants something, you could sell it to them almost instantly. That means that our prices are probably in many cases too low for a lot of jobs. So moving on to the next slide, you can see that we're going to look at that gap specifically, and the gap is at an all-time high. So this is just the difference between the two lines on the last slide, and this is showing us that the overall gap is now at more or less an all-time high, starting with the pandemic. Right on the right, you can see it peaked at almost double, whereas we've been at in many cases, there were more openings, there were fewer openings than there were people looking for work, and now it's flipped. So moving on, we're going to now start tackling the consumer angle and what's going on with consumer spending. So jumping into the first slide here on the consumer set, what we can see is there's a big impact that interest rates have on overall home sales. And what we'll look at here specifically is single family home sales and the impact that the 30-year mortgage has on it. The 30-year mortgage was already dropping, if you look at the left-hand half of the chart there, and the single family home sales were trending upward beforehand. But then right in the center of the graph, you have the onset of COVID. And when that happened, there was that 30% reduction roughly from a baseline right in the center. You can see that it's base marked at 100, and then that red line drops to about 75. And what that means is there was a 25% reduction in the 30-year mortgage rate. And at that exact same time, you can see the green line shot up because this created this temporary arbitrage opportunity for consumers to buy into the market a cheaper asset with a cheaper price, and that bid up the price of homes. But this had a number of downstream consequences. So the first thing is we created a lot more households in single family homes. The other thing it did was it took everybody who was already in a single family home, and the price of their homes being bid up created more home value, which created more home equity. So we've created trillions of dollars in home equity for people in existing homes. We've also, for a lot of those same people, if they had mortgages, they were able to refinance their mortgages and free up cash flow. So you've got more cash flow, you got more home equity, and you've got more homeowners. And this is why it's really important to stress this importance around pricing, is that consumers are in a really good position right now in terms of households that own homes. Right now, currently this year, not the best time to buy a house because the house prices have risen so much and because now interest rates are starting to rise again. But in terms of anybody who's been in their home for a couple of years, they are certainly going to have a significant amount of unlocked spending power that they otherwise would not have had. Moving on to this next slide. And this is just showing the gap actually. So Tim, if you just want to cycle through to the next slide, we'll get past this. This is just sort of showing the gap between the two as they rose. This is showing the actual growth in the home equity gains that came along. And you can see in green, we've got the 2019 distribution of home values across the country. And in the blue, you can see the 2021 distribution of home values across the country based on the rates of increase we saw in 2019 and 2020 and 2021, which were roughly which was almost a 25% increase if you stack those years on top of each other and look at that compound growth. So that's unlocked a lot of equity, B, it's been a lot of leveraged gains, and C, you can see that growth in the share of homes that are over 500,000 has been pretty considerable, right? You've got almost a third increase in the share of homes that are that valuable, and that's a big deal in terms of consumer spending power and in terms of how rich people feel. And at the same time, also recognize that as interest rates go up, people are going to get locked into those cheap mortgages and might not necessarily try and sell, because even though they get the benefit of the home equity gain, if they were to sell, they'd have to buy back into the market at the higher price. So all of a sudden, a remodel becomes significantly more competitive versus to selling and buying another asset. So if we move on to the next slide, on this piece, you can see the actual impact of building on this whole equation that we've been discussing. You can see that total housing has been rising since the 2000s, but it is for the first time now being exceeded by occupied housing. So the gap between the two, the gap between occupied and total, is our vacancy rate. And that is a measure for how much slack there is in the buying market. If you look at the gap between them, you can see we had that peak period in the mid 2000s, like the 2009-2010 period, where the housing market had crashed in the Great Recession, and there was the biggest gap we've seen. But starting in about 2014, that gap started to shrink, and then starting with the pandemic, it changed. So right there on the far right-hand side, you can see for the first time in 20 years, the growth in occupied housing is exceeding the growth in total housing. And that's because the millennial generation is hitting their peak formation of households and careers and home buying and family formation. And that is what is driving this tension of shrinking vacancy within the housing market. And this is, I think, really, really telling that story of how much slack there is in the market and why everybody's so busy and why there's not enough labor to go around. Because we got used to this period in the 2010s where there wasn't that much room, where there was plenty of room for people to go in and buy vacant houses, and that's evaporated at this stage. Moving on, what we can see is there's also a growing glut of incomplete homes that are that are coming online, and you can see that the gap on the far right-hand side between starts and completes is growing and has never been greater. Moving on to the next slide, you can actually see the difference between these two lines. So right here, you can see that the gap has been growing over the last 3 years since sort of the onset of the pandemic, and now it's at an all-time high in terms of how many homes are out there incomplete. They've been started and they haven't been finished. And what that's really telling us is that in addition to the total number of homes going up, we've also got a lot of incomplete inventory, and that's a really, really good gauge of how well the supply chains are functioning. So right now, not very well, and that's what we're seeing because people can't complete homes and they can't get the labor to complete homes. So what's this overall telling us, Tim, if we want to jump on here? Right now, the current environment is pretty toxic to somebody who's trying to run their business in a really, really stable way and just do what they've always been doing. You want to really be intentionally thinking about this, but you also want to be planning for the future. And there is a housing replacement super cycle that sort of takes place in terms of replacing the existing homes that have been built. That's not going to happen at an even pace, because if we build a lot of homes all at once, those will have to be replaced more or less all at once because everything tends to age at roughly the same rate. And right now we are running into a very interesting period where we're looking at the replacement super cycle for a lot of outdoor pieces of the home. If you assume a roughly 20 to 25 year replacement rate on well-installed siding and well-installed roofing, we are coming into the period where all of the housing stock that was built in the early 2000s is needing replacement, and that is stacking on top of the existing trend in new home construction. So you can see in the red, that's new home construction, and then just forecasting that out at relatively stable, you can see that we are running into this period where the replacements are also rising, and that gray line is showing us how much overall demand there is for this entire sort of housing universe and what we are running into in terms of both competition for labor and materials. So I think as we're coming up on time, Tim, do we have one more slide or is this our last one?
This is the last one, Mischa.
This is our last one, perfect. So what are the final takeaways from all this stuff? Why are we looking at charts? Charts are not as useful as, here's how to install a roof. But what they can really teach you is right now you're running a business. You want to protect all of your hard work. You want to plan and make the right investments. This is a very volatile period. First and foremost, protect your investments from inflation. We recently polled our Angi network of pros to find out what the impact of gas pricing was having. 95%, more or less unanimous, of pros were running into issues of either noticing the higher gas prices impacting their bottom line or of expecting it to get even worse. Only 3/4, 75%, were actually saying that they might raise their rates as a result of it. So while on the one hand, that's a high number saying that rates are going to be higher, it's not the same. And if you're not planning on raising your rates because your gas prices are going up, you're probably not thinking through all the implications of it. And so really be intentional about that. Also recognize that labor is not going to get cheaper, it's going to get more expensive. That's going to be true for a lot of materials, not uniformly, it depends on the material, but a lot producers are going to continue to pass their rising price on to you. And consumers, at the other hand, are in a really good position by and large. That's not a universal statement, but if you're looking at the upper end of the income spectrum that owns a lot of homes and is going to be doing higher cost remodels, they've got more home equity than they've ever had. They've got cheap interest rates on their existing debt. They've got effectively a negative interest rate on their mortgage because they've got a 2.8, 2.9% mortgage with inflation at 8 or 9%. So overall, the position is very good for them to absorb some of those costs, and you want to make sure that you're